All right, listen up. If you're still out here throwing darts at a Forex chart, hoping the market gods take pity on you, we need to have a chat. Because today I'm handing you something real, a strategy that actually works. No fluff, no nonsense. Just a method that keeps you on the right side of the market without praying to the pip gods. This strategy is dead simple. 2 rules, 1 confirmation. That's it. But if you ignore even one piece, you're just another retail trader donating money to the market. So let's break it down. And by the end of this, you'll never look at a trend the same way again. Rule number 1, we need an extended trend. Now, I know some of you love jumping in early, catching tops and bottoms, thinking you're some kind of trading ninja. But guess what? The market doesn't care about your ego. You're not predicting, you're reacting. An extended trend means price has been moving in one direction for a while, pumping hard or bleeding out. Why do we care? Because trends exhaust. Markets move in cycles, and after every sprint, the market needs to catch its breath. That's where we come in. So stop trying to be the first genius to call a reversal. Instead, wait for the trend to stretch itself thin. Let the FOMO traders pile in late. Let them push price to ridiculous levels, and then we strike. This is the part where patience comes in. You don't jump in just because price has been moving up or down for a while. You wait for signs. You let the market tip its hand before making your move, because if you don't, you're just guessing. Now here's where it gets spicy. RSI Divergence. RSI, or the Relative Strength Index, is basically a speedometer for price momentum. When price is still making higher highs, but RSI is making lower highs, bam, that's your red flag. Why? Because RSI is showing you the move is running out of juice. It's like a car that's still rolling forward, but the gas tank is on E. And if you're smart, you're not trying to hitch a ride on a car that's about to stall. So when you spot RSI divergence, you know the trend is on its last legs. You're no longer guessing, you're seeing the market's exhaustion in real time. But here's the thing, you don't take a trade just because you see RSI divergence. You use it as a warning. It's like seeing storm clouds on the horizon. You don't run inside just yet, but you grab your umbrella and get ready. All right, so we've got our extended trend. We've got RSI divergence. Now we need one last piece of proof before we jump in, a trend line break. A trend line is just a diagonal line connecting the lows of an uptrend or the highs of a downtrend. As long as that trend line holds, the trend is still alive. But when price breaks that trend line, game over. That's our green light. That's when we pull the trigger. Because here's the truth. Institutions move the market, not your little retail account. And when a trend line snaps, it means the big players have started exiting their positions. And guess what? We follow the money. You want to enter on confirmation, not anticipation. Too many traders jump in the moment they see RSI divergence, thinking they've caught the top or bottom, and then they get wrecked as price squeezes even higher. Let price prove itself. Let the trend line break, and then move in. So how do we enter? Simple. Spot the extended trend. Price has been moving aggressively in one direction. Check RSI. If it's diverging from price, we've got a red flag. Wait for the trend line break. That's our signal to enter. For stop losses, keep it above the last high in a short or below the last low in a long. And for targets, aim for the next major support or resistance. Now, if you want to get fancy, you can trail your stop. But let's be real. Lock in your profits and move on. The market doesn't owe you anything, so take what it gives you. Now let's talk about the real killer of traders, psychology. You can have the best strategy in the world, but if your mindset is garbage, you're going to blow your account. That's just facts. The market is designed to mess with your head. It wants you to doubt yourself, to second-guess your trades, to chase price like a fool. Your job? To stay cool under pressure. If you let emotions control your trades, you'll make mistakes, you'll exit too early, you'll hold too long, you'll revenge trade, and every single one of those mistakes costs you money. The traders who make it, they follow their system no matter what. They don't panic when a trade goes against them. They don't get greedy when a trade is in profit. They execute with discipline every single time. That's the difference between a pro and an amateur. And that's it. No magic indicators, no overcomplication, just logic, just discipline. But here's the catch, you need patience. Most traders lose because they force trades. They jump in too early. They ignore confirmations. They let their emotions trade for them. So don't be that guy. Follow the steps, stay disciplined, and let the market come to you. Because in the end, the market doesn't reward gamblers. It rewards patience. This is George, and I will see you at the top.